Let me tell you something that might surprise you coming from someone who has spent over 70 years picking individual stocks. If I had to give one piece of advice to the average investor, one single recommendation that would serve them better than anything else I could possibly share, it would be this: stop trying to pick stocks, stop listening to stock tips, stop watching financial television and chasing whatever is hot this week. Instead, put your money into low-cost index funds and leave it there for decades. I have said this publicly many times. I have written about it in my annual letters to shareholders. I have even made $1 million bet proving that index funds beat professional money managers, and yet people still do not listen. They still think they can outsmart the market. They still believe the next hot stock tip will make them rich. They still pay excessive fees to advisors and fund managers who deliver mediocre results at best. Today, I am going to be specific about exactly which funds I would recommend. I am going to tell you the 3 best Vanguard ETFs for long-term growth. And I am going to explain why most of what people are buying in their portfolios is, frankly, trash that is costing them a fortune in fees while delivering inferior returns. Now, before you dismiss this as too simple, before you assume that something so straightforward cannot possibly work, let me share a story that changed how I think about investing for regular people. Back in 2007, I made a public wager that would settle a debate that had raged for decades. I bet $1 million that a simple S&P 500 index fund would outperform a collection of hedge funds over a 10-year period. The hedge funds were selected by a firm called Protégé Partners, experts who spent their careers identifying the best money managers in the world. They picked 5 funds of funds, which means they were selecting from the absolute elite of the hedge fund industry. These were not amateur operations. These were sophisticated investors charging 2% annual management fees plus 20% of any profits. They employed PhD mathematicians and former rocket scientists. They had access to investments and strategies unavailable to ordinary investors. They used leverage and derivatives and complex algorithms. They were supposed to represent the very best that Wall Street had to offer. You know what happened? It was not even close. Over those 10 years, the index fund returned about 125%. The hedge fund portfolio returned about 36%. The simple, boring index fund beat the best and brightest on Wall Street by nearly 90 percentage points. And this was not a cherry-picked time period. This was a decade that included the 2008 financial crisis, one of the most volatile periods in market history, exactly when active management was supposed to prove its value. That bet crystallized something I had observed throughout my career. The vast majority of professional money managers failed to beat simple index funds after accounting for their fees. And if the professionals cannot do it consistently, what chance does the average person have trying to pick stocks on their own? I want you to understand what this result means for you personally. The hedge fund managers in that bet were compensated handsomely for their supposed expertise. Their clients paid millions in fees, believing they were getting superior investment management. Instead, they would have been far better off putting their money in a fund that any beginner could access for essentially nothing. The hedge fund industry did not lose that bet because they lacked intelligence or resources or effort. They lost because the game itself is stacked against active management. The fees they charge create such a headwind that even genuine skill cannot overcome it consistently. And most managers do not have genuine skill. They have luck that runs out eventually. Since that bet concluded, I have become even more convinced that the average person should never try to beat the market. The evidence has only grown stronger. The studies have only become more comprehensive. And yet the investment industry continues to separate people from their money by promising performance it cannot deliver. This brings me to Vanguard. I have to give credit where it is due. Jack Bogle, who founded Vanguard and created the first index fund for individual investors, did more for ordinary Americans than almost anyone in the history of finance. He was not trying to get rich. He structured Vanguard as a mutual company owned by its fund shareholders. This meant the company had no incentive to charge excessive fees. The lower the costs, the better for everyone. When Bogle launched the first index fund in 1976, Wall Street laughed at him. They called it Bogle's folly. They said no one would want a fund that just matched the market average. The fund industry ran advertisements mocking the very concept of accepting average returns. What they did not understand, or perhaps did not want to understand, was that matching the market average after accounting for the fees that active managers charge actually beats most active managers over time. The math is simple and irrefutable. Let me explain why this happens, because understanding the logic will give you conviction to stick with this approach through decades of market volatility. Imagine the entire stock market as a pie. All investors collectively own that entire pie before costs. The average dollar invested in stocks must earn the average market return. This is not opinion. This is arithmetic. It is literally impossible for the average dollar to earn anything other than the average return. Now divide investors into two groups: passive investors who own index funds and active investors who try to beat the market before costs. Both groups must earn the market return on average, but active investors pay higher fees. They pay management fees, trading costs, research expenses, marketing costs. Passive investors pay almost nothing. After costs, passive investors must beat active investors on average by the amount of the cost difference. This is not a theory. This is mathematical certainty. The only way active management can win as a group is if passive investors somehow earn below market returns, which is impossible since they own the market itself. Every dollar that goes to Wall Street fees is a dollar that does not go to investors. And those dollars add up to a staggering amount over a lifetime of investing. Here are the 3 Vanguard ETFs I would recommend for anyone building long-term wealth. I will explain each one in depth, why it belongs in your portfolio, and how to think about combining them for your specific situation. The first ETF is VOO, the Vanguard S&P 500 ETF. This is the single most important investment most people will ever make. If you only buy one fund for the rest of your life, this should be it. I am not exaggerating when I say this fund alone could be your entire investment strategy and you would outperform most sophisticated investors. VOO tracks the S&P 500 index, which contains the 500 largest publicly traded companies in America. When you buy shares of VOO, you are buying a tiny piece of Apple, Microsoft, Amazon, Google, Berkshire Hathaway, and 495 other companies. You are instantly diversified across every major sector of the American economy: technology, healthcare, finance, consumer goods, energy, industrials, utilities, real estate, all of it in one simple purchase. The expense ratio on VOO is 0.03%. Let me put that in perspective, because most people do not truly grasp what this means. For every $10,000 you invest, you pay $3 per year in fees. $3. The average actively managed mutual fund charges around 1%, which would be $100 on that same $10,000 over a 40-year investment horizon. That difference compounds into hundreds of thousands of dollars that stay in your pocket instead of going to Wall Street. Let me give you a specific example of how fees compound. Assume you invest $100,000 and earn 8% annually before fees. After 40 years with a 0.03% expense ratio, you would have approximately $2,100,000. With a 1% expense ratio, you would have approximately $1,500,000. The difference of 970 percentage points in fees costs you over $600,000. That is $600,000 that you earned that should have compounded for your benefit, that instead went to enrich fund managers. The historical returns of the S&P 500 speak for themselves. Over the past century, the American stock market has returned roughly 10% annually, including dividends, some years much more, some years much less. But the long-term average has been remarkably consistent. There is no other asset class with a comparable track record of wealth creation over long periods. Not real estate, not bonds, not gold, not commodities, not any alternative investment that Wall Street has dreamed up. Some people worry that the S&P 500 is too concentrated in technology stocks right now. The largest companies, the Apples and Microsofts and Googles, make up a significant portion of the index. But this is exactly how capitalization weighted indexes are supposed to work. The biggest, most successful companies get the largest weightings as their fortunes change. So do the weightings. You do not need to predict which companies will succeed. The index does that work for you automatically, constantly rotating toward the winners and away from the losers. Think about what this means practically. 50 years ago, the largest companies in America were completely different from today. IBM, General Motors, Exxon, AT&T, these were the giants that dominated the index. Today it is Apple, Microsoft, Google, Amazon, Nvidia. If you had tried to pick the winners 50 years ago, you probably would have been wrong. But if you owned the index, you captured all of that transformation automatically. You owned IBM when it was dominant. You owned Apple as it grew to dominance. You did not have to predict anything. You just had to stay invested. I have told the trustee who will manage my wife's inheritance to put 90% of the money in VU or an equivalent S&P 500 index fund. If that is good enough for the person I love most in the world, it should tell you something about my conviction in this approach. The consistency of American business over time is what gives me such confidence in this recommendation. The S&P 500 has survived world wars, the Great Depression, oil embargoes, banking crises, tech bubbles, and every other challenge the economy has faced. The specific companies change, but the index endures and compounds wealth for patient owners. When you buy VU, you are not gambling on any single company succeeding. You are betting on American capitalism continuing to function and grow over decades, given the legal frameworks, the infrastructure, the culture of innovation, the depth of capital markets, and the rule of law that protect property rights. I believe that bet is about as safe as any bet in investing. Some younger investors ask me whether the S&P 500 is too focused on incumbent companies, whether it misses the innovative startups that will define the future. But here is what they do not understand. Those innovative startups, if they succeed, will grow large enough to join the index. You do not need to identify them early. You just need to own the index and they will come to you. Netflix, Tesla, Nvidia, these were all small companies that grew into index constituents. The patient index investor captured their gains without having to identify them in advance. The second ETF is VTI, the Vanguard Total Stock Market ETF. This fund is similar to VU, but even more comprehensive. While VU holds the 500 largest companies, Vermont I holds essentially every publicly traded company in America. We are talking about nearly 4,000 stocks, from the largest mega caps down to small companies most people have never heard of. The expense ratio is identical to VU at 0.03%. You are getting even broader diversification at no additional cost. The returns over long periods are very similar since the S&P 500 companies dominate both indexes by market capitalization. But VTI gives you exposure to smaller companies that VEO excludes. Why does this matter? Historically, small company stocks have slightly outperformed large company stocks over very long time periods. Academics call this the small cap premium. Small companies are riskier, less stable, more likely to fail. But the survivors can grow at rates that mature giants cannot match. This small cap premium is not guaranteed to continue. And it has been absent in recent decades, but the diversification benefit is real regardless. When large caps struggle, sometimes smaller companies perform better. Owning the entire market smooths out some volatility and ensures you never miss a category that happens to outperform. You are not betting on which size segment will win. You own them all and let the market sort out the allocation. For most investors, the choice between VO and VTI is not critical. They are both excellent. If I had to choose one, I might lean slightly toward VTI for the broader diversification. But either fund will serve you extraordinarily well over decades. The important thing is to pick one and stick with it, not to agonize over marginal differences between two excellent options. Some people own both VOE and VTI, thinking they are getting additional diversification. This is a mistake since the 500 companies in VO are also in VTI. You are just paying for overlapping exposure. You are not getting additional diversification. You are simply overweighting large caps relative to a pure total market approach. Pick one or the other, not both. The third ETF is VX's, the Vanguard Total International Stock ETF. This fund owns stocks from developed and emerging markets outside the United States. We are talking about companies in Europe, Japan, the United Kingdom, China, India, Brazil, Australia, South Korea, and dozens of other countries. Over 8,000 stocks spanning most of the world's publicly traded companies outside America. The expense ratio is slightly higher and 0.07%, still extraordinarily cheap by industry standards. You pay $7 per year for every $10,000 invested. This gives you exposure to thousands of international companies that VTI and VO do not include. Why bother with international stocks when America has been the best performing major market for so long? Because past performance does not guarantee future results. And diversification provides insurance against concentrated bets going wrong. The American market's dominance is not preordained. It has not always been true in the past, and it may not be true in the future. Let me share some history that illustrates this point. From 2000 to 2009, international stocks significantly outperformed American stocks. If you had been 100% invested in the S&P 500 during that decade, you would have actually lost money after inflation. International diversification would have cushioned that painful period substantially. The investors who stayed fully invested in international markets during that decade were rewarded while purely domestic investors suffered. Of course, from 2010 through today, American stocks have dramatically outperformed international markets. This is why many investors have abandoned international diversification entirely. They look at recent returns and assume America will always win. But that assumption could prove very costly if the pattern reverses, which it has done before, and could easily do again. The valuations tell an interesting story. American stocks trade at premium valuations compared to historical norms and compared to international markets. The price-to-earnings ratios, the price-to-book ratios, the dividend yields, by virtually any measure, American stocks are more expensive than international stocks. This does not mean international stocks will definitely outperform going forward, but it does suggest the expected returns from current prices may favor international markets. I think of international allocation as insurance. You hope you do not need it. You hope American stocks continue outperforming forever. But if they do not, having 20 to 30% of your portfolio in international stocks provides meaningful protection. The cost of this insurance, in terms of potentially slightly lower returns if America keeps winning, is modest compared to the protection it provides against scenarios where America underperforms. There is also a psychological benefit to international diversification that people underestimate when you are fully invested in one country and that country's market declines while other markets rise. It is emotionally difficult to stay the course. You feel like you made a mistake. You are tempted to shift your strategy at exactly the wrong time. Having international exposure reduces this emotional challenge because you always have some part of your portfolio that is performing reasonably well. And we can tell you honestly that international stocks have been frustrating to own for the past 15 years. American stocks have so dramatically outperformed that many investors have given up on international entirely. But that is precisely when I think international exposure matters most. The longer American outperformance persists, the more extreme the valuation gap becomes, and the more likely a reversal becomes. No one can predict when that reversal will happen. But prudent investors do not need to predict. They simply maintain diversification and let time sort things out. Now let me explain why most of what people are buying instead of these funds is trash that is costing them a fortune. The average actively managed mutual fund charges about 1% in annual fees. Some charge much more, and the evidence is overwhelming that these fees are not justified by superior performance. Study after study shows that the vast majority of active funds underperform their benchmark indexes after fees. The longer the time period studied, the worse active management looks. A recent study by S&P Dow Jones Indices found that over a 15-year period, more than 90% of actively managed large-cap funds underperformed the S&P 500 90%. These are professional managers with teams of analysts, with access to company management, with sophisticated research tools, and 90% of them failed to beat a simple index fund that a child could buy with a few clicks. But it gets worse. Actively managed funds also generate higher tax bills because they trade more frequently, realizing capital gains that get passed to shareholders. Index funds trade minimally, only when the underlying index changes, so they generate fewer taxable events. The tax efficiency of index funds adds another 0.5% or more of annual advantage in taxable accounts. Then there are the hidden costs that most investors never see. Trading costs, market impact costs, cash dragged from funds holding money out of the market. These costs do not show up in the expense ratio, but they eat into returns nonetheless. Active funds can easily cost 2 to 3% annually when you add up all the visible and hidden costs. That is 2 to 3% per year that you are paying for the privilege of probably underperforming a simple index fund. And do not get me started on financial advisors who charge 1% or more of assets under management to do little more than put you in funds that underperform indexes. 1% does not sound like much until you realize it compounds for decades, over a 40-year career of saving and investing. That 1% annual fee could cost you hundreds of thousands of dollars. In some cases, it could cost you over $1 million that would otherwise be yours. The target date funds that many people own in their retirement accounts are better than actively managed funds, but still more expensive than necessary. These funds charge 0.1 to 0.2%, typically, compared to 0.03% for VU or VTI. That difference seems small, but it compounds over decades into meaningful money. Target date funds are fine if you want complete simplicity, but you can do better with a little effort. The thematic ETFs and sector funds that have proliferated in recent years are particularly troublesome. Funds focused on specific themes like artificial intelligence, clean energy, cannabis, space exploration, or whatever is trendy at the moment, charge higher fees and encourage investors to chase performance. By the time a theme is popular enough to have dedicated funds, much of the opportunity has already been captured in prices. Investors pile in at the peak of enthusiasm and then suffer when the theme disappoints. Leveraged and inverse ETFs are even worse. These products are designed for short-term trading and decay significantly over time due to their daily rebalancing mechanics. I have seen people lose fortunes by holding these products, thinking they were making long-term bets. They were not. They were slowly bleeding money to mathematical forces they did not understand. These products should not exist for retail investors, but they do, and they destroy wealth every single day. Let me explain how to actually implement this three-fund approach, because the details matter and getting them right can make a significant difference over time. The allocation between U.S. stocks, international stocks, and bonds depends on your age, your risk tolerance, your income stability, and your specific circumstances. But here is a starting framework for someone focused on long-term growth. If you are young, in your 20s or 30s, you can afford to be aggressive. Consider putting 80 to 90% in VOO or VTI and 10 to 20% in VXs. You have decades to recover from any market downturns. The volatility that scares older investors is actually your friend because it creates opportunities to buy more shares at lower prices. The crashes and corrections that older investors dread are gifts to young investors who are still accumulating shares. If you are middle-aged, in your 40s or 50s, you might shift to 70% U.S. stocks, 20% international stocks, and start adding some bonds for stability. The Vanguard Total Bond Market ETF, ticker BND, is an excellent low-cost option for bond exposure. This provides more stability as you approach retirement while still maintaining growth potential. If you are approaching retirement or already retired, you might hold 50 to 60% in stocks split between us and international, with the remainder in bonds. You need your portfolio to provide income and preserve capital, not just grow aggressively. The stock allocation provides growth to keep pace with inflation. The bond allocation provides stability and income for living expenses. These are just guidelines. Your specific situation might warrant different allocations, but the principle remains constant. Keep costs as low as possible by using index funds. Diversify broadly across asset classes and geographies, and resist the temptation to tinker constantly in search of better returns. Set up automatic investments regardless of market conditions. This dollar-cost averaging approach removes the temptation to time the market and ensures consistent wealth building. Markets will go up and markets will go down by investing the same amount every month. You automatically buy more shares when prices are low and fewer when prices are high. Reinvest all dividends automatically. The compounding effect of reinvested dividends is enormous over long periods. A substantial portion of total stock market returns historically have come from dividends, not just price appreciation. Letting those dividends accumulate in cash instead of reinvesting them sacrifices significant compounding. Rebalance annually at most. Once a year, check if your allocations have drifted significantly from your targets. If U.S. stocks have soared and now represent 90% of your portfolio when you wanted 80%. Sell some U.S. funds and buy international or bonds to get back to target, but do not obsess over small deviations. Rebalancing too frequently just generates transaction costs and taxes without improving returns. Ignore short-term market fluctuations entirely. The daily, weekly, and monthly movements of stock prices are noise. They tell you nothing about where prices will be in 10 or 20 or 30 years. Watching prices obsessively leads to emotional decisions that destroy returns. Check your portfolio quarterly at most, better yet. Check it annually and spend the rest of your time living your life. Never sell in a panic when markets crash, and they will crash periodically. The worst thing you can do is sell crashes, create the buying opportunities that make long-term investors wealthy. If you sell during crashes, you lock in losses and miss the eventual recovery. This is the most common and most costly mistake that individual investors make, and it is entirely preventable. I have lived through numerous market crashes over my 70-plus years of investing. Every single time, people panic. Every single time, they sell at the worst possible moment. And every single time, the market eventually recovers and goes on to new highs. The pattern is remarkably consistent. The crash feels like the end of the world while it is happening. Then a few years later, it is barely a blip on a long-term chart. The investors who prosper through crashes are the ones who maintain their composure and stick with their strategy. Better yet, they are the ones who view crashes as opportunities to accelerate their wealth building by buying more shares at temporarily depressed prices. If you can develop this mindset, if you can train yourself to see falling prices as sales rather than disasters, you will have an enormous advantage over most investors. The most important factor in investment success is not fund selection. It is behavior. The investors who earn the best returns are the ones who contribute consistently, who do not panic during downturns, who do not chase hot performance, who stay the course through decades of market volatility. Every study on investor behavior shows that the average investor earns significantly less than the funds they invest in. Why? Because they buy after prices have risen and sell after prices have fallen. They let emotions override logic. They watch financial television and get scared or excited and make decisions at exactly the wrong moments. If you can simply buy these 3 Vanguard ETFs, set up automatic contributions, and then ignore your portfolio for years at a time, you will outperform the vast majority of investors. Not because you are smarter or have better information, but because you are not sabotaging yourself with constant activity. Let me close with something personal. I have been extraordinarily fortunate in my career. I have had the opportunity to study businesses deeply, to meet with management teams, to develop analytical frameworks over decades of practice. Stock picking has been my life's work and my greatest passion. But I recognize that what works for me does not work for most people. Most people do not have the time, the interest, or the temperament to analyze individual businesses. They should not try to do what I do any more than I should try to perform surgery or argue cases before the Supreme Court. There is no shame in recognizing the limits of your expertise and choosing an approach that works for people without specialized skills. For the average person, putting money into VO Vermont I and VXs and leaving it alone for decades is not settling for average. It is a strategy that will beat most professional investors. It will beat most stock pickers. It will beat anyone who pays high fees or trades excessively or makes emotional decisions. Stop buying the trash that Wall Street sells. Stop paying fees for underperformance. Stop pretending that complexity equals sophistication. The simple approach wins. It has always won. It will continue to win. The three funds I have described today will cost you essentially nothing in fees. They will give you exposure to thousands of companies across the globe. They will automatically adjust as the economy evolves. They will not require you to read annual reports or analyze balance sheets or predict which industries will thrive. They will simply let you own a piece of global capitalism and benefit from its long-term growth. That is not a compromise. That is wisdom. Let me leave you with a final thought about what matters most in building wealth. The financial industry wants you to believe that investing is complicated, that you need experts, that you need sophisticated strategies, that you need to constantly monitor and adjust. They want you to believe this because complexity justifies their fees. If investing were simple, why would you pay them? But investing is simple. Buy broadly diversified, low-cost index funds, contribute regularly, reinvest dividends, ignore market fluctuations, hold for decades. That is it. Everything else is a distraction that costs you money without adding value. The three Vanguard ETFs I have shared today, VU or VTI for American stocks and VXs for international stocks, are all you need. They give you exposure to essentially every public company on the planet for fees so low they barely register. They require no expertise to own. They require no monitoring or adjustment. They just compound wealth year after year for patient owners. The gap between what the average investor earns and what they could earn with this simple approach is enormous. Studies suggest the average investor underperforms index funds by 3 to 4 percentage points annually due to fees, taxes, bad timing, and emotional decisions. Over a lifetime, that gap compounds into hundreds of thousands or millions of dollars. You do not need to join that majority. You can choose differently. You can stop buying the trash that Wall Street sells. You can stop paying fees that destroy your wealth. You can embrace simplicity and let compound interest work its magic over decades. I have made my fortune through stock picking, but I am telling you that stock picking is not for most people. What is for most people is exactly what I have described today. 3 low-cost index funds, consistent contributions, patience, discipline, time. Your future self will thank you for starting this approach today. Stop making it complicated. Start making it work.